So many times we see that people come in to see us and they tell us, my financial planner and my CPA are not communicating together. I talk to my financial planner and ask for tax planning help, and they tell me to go see my CPA. And then I talk to my CPA, and my CPA says I only do tax prep, I don't do tax planning, and you need to go figure this out on your own. Well, that's probably not the right solution. So we're going to break down in today's video of why CPAs tell you they can't help you with retirement taxes, or maybe they don't tell you, but they're just not necessarily doing it because all they do is prep taxes. And then we're going to talk about the opportunities that you have by doing some tax planning, by knowing what's out there, because so many times we hear, I don't know what I don't know. And so we hope this video and this YouTube channel here can help open your eyes to what's possible. And so if this is your first time watching, you have never subscribed to this channel, go ahead and subscribe. We're going to keep many of it coming. We talk to those who are Midwestern millionaires, those who have $1 million or saved, and those with pensions, and who we call the 2% Club, which I'm also writing a book about. So that's what's in store for today's video.
Joe knows taxes.
Joe knows the market.
Joe knows Social Security.
Joe knows income planning.
Joe knows pickleball? No.
This is Joe Knows Retirement.
So let's think about this here. When you do tax prep, typically your CPA or your accountant or your enrolled agent is only looking at your tax situation that year. It's reactive and not proactive. When we build a retirement plan with the clients we serve, we're typically looking 30 years out. We're not just looking at the decisions we're making today, but how's that going to impact the tax savings over time and the net worth at the end of time. And so tax prep and tax planning are two totally different things. Now, at our firm, Peak Retirement Planning, where I'm the CEO and founder of, we do both. We have CPAs on staff to help our clients with tax prep, and then we also do tax planning throughout the year to utilize all the opportunities like tax loss harvesting or Roth conversions or tax efficient income planning, all the things that can really make a difference in saving money over the long term. The ones that mostly CPAs aren't really having enough time to do that. And so I'm going to break this down a little further of why I think it's so important to have these two individuals work together. I'm not saying to get rid of your CPA. I'm saying to make sure that they're working together with your financial planner. I think everyone should have a professional do their tax prep because there's always value to be had. There's always things that you can find that maybe you're not able to see on your own. And so a lot of times though, the disconnect is one person's thinking the other one's doing it, as I mentioned earlier. And you have to think about it. I mean, there's such a shortage of CPAs. There's even a shortage of financial planners. The average age of a financial planner is 56. There's going to be 100,000 advisors retiring in the next 10 years. That's 1/3 of the population of advisors. And so there's just not a lot of excitement to offer tax planning is something that we see often. If you are working with a firm that does tax planning and they're strategically looking at things like Roth conversions and they're showing you a tax map every single year, then you're in a great spot. There's not a lot of firms out there like that, but if you found that, congratulations. If you have not, and if you're paying a full 1% or more in management of your investments, and that's all they're doing is managing your investments, you're probably leaving a lot of money on the table and you're probably overpaying for that service in today's marketplace. And so a lot of advisors have not changed. They've always charged that way. They've never seen a reason to because retention rate in our industry is so high. Clients have like a 95% chance they'll never leave their advisor no matter what. And so with that being the case, advisors have gotten comfortable. Advisors have gotten comfortable offering one out of what we call our 5 pillars while also charging a full fee. And so we'd highly encourage you that if you're working with a team who's not doing this, seek out and find a team so you can get what you deserve. You don't deserve to pay that much and not get this full service. And that's one of the big reasons why these firms don't do it though, is because they don't have to. Why would they spend extra money trying to offer this service, extra time, which is money, and then they still have the same result of 95% of their clients staying? So I'm not saying it's right, I'm just saying it's real. And so we've made a decision with our firm is that we want to be the best and not the biggest. We're not going to bring on thousands of clients every single day that we can't serve just to get more revenue. We make sure that we have a specific ratio of 50-1 advisors to every client to make sure that we can do really deep intentional tax planning to make this more of a boutique experience. And so that could be a really good question to ask the firm you're working with is, what is your advisor to client ratio to make sure that that is in check so that you're going to get that deep level of understanding. For example, One Big Beautiful Bill just got passed, 900 pages of tax law. We call all of our clients to see, hey, here's the opportunities that are going to exist for you. Here's the things that we're doing to be ultra proactive. Or last quarter where the market was down and then it came back up. Well, during that time, we were looking at doing Roth conversions so that all of the growth coming back was tax-free. And so if you don't have a team that's being proactive and calling you during those times, you may be missing out on those opportunities. Or if you're DIYing it and you're just not being that active, you may be missing opportunities as well. So that's on the tax planning side of things on why that is so valuable. Now, your CPA is definitely not going to be calling you throughout the year. In most cases, if you do have a CPA that's doing that, then that's great. You're probably paying them quite a bit of money is what my guess is. But with CPAs, they're more reactive. They're only going to talk to you from January to April typically. They're not going to proactively call you throughout the year. And that's a big gap that many people have. Many people don't have that tax planning aspect to it. And you have to remember, CPAs, most of them have about 1,000 clients or 500 to 1,000 clients, and all they're doing is prepping taxes. And then in the off season, they're taking it easy because they're working 60, 80 hours to get all the tax returns done. And so if you ask your CPA to do tax planning, my guess is they're probably not going to want to do it, nor do they understand your full situation, all of your goals, to be able to do it really efficiently. For example, we talked about Roth conversion. Let's stay on that topic. With a Roth conversion, there's a lot of factors that are involved in that. It comes down to, well, do you want to leave money to your spouse, to your kids? Do you want to, what's your tax rate now? What's it going to be in the future? How's this going to impact Medicare premiums? What about Social Security taxation? What about your pension that plays into this? There's a lot of things to factor in when making that decision in itself. And most times CPA don't spend enough time with their clients to be able to understand the exact strategies to implement. And so that's why we like having it in-house so both professionals can work together. But that's where the gap is in most cases, is that the advisor won't do tax planning and the CPA won't do tax planning. And so it's kind of left just void for you to figure out. And so that's one of the things that, on this video today, when we talk about what CPAs aren't telling you if you're expecting them to give you advice, is that Roth conversion strategy I just mentioned. A Roth conversion is when you move money from a tax-deferred investment to a tax-free. So that requires you having to pay the taxes now on that money, but then all of the growth moving forward is tax-free. Now, a lot of CPAs may not like that idea because a CPA has been taught all their life to defer taxes. Never pay a tax until you have to. Keep kicking the can down the road. And that could have been a great strategy looking back, in 1981 when tax rates were much higher than they are today. Well, we just got the passing of the One Big Beautiful Bill. I believe tax rates are the lowest that we're ever going to see. And now could be an actual great time to start paying the taxes, knowing if we don't pay it now, we're going to have to pay it in the future on these tax-deferred investments, and that's what's called a required minimum distribution. When you turn 73 or 75, depending on when you're born, then you're required to take out money from these accounts, and you're going to be forced to pay taxes on whatever it is at that time. And if you're the type of person watching this with a pension, with $1 million or more saved, your RMD at that time could be 40 or 50,000 or more on top of your other income streams of that pension, of that Social Security, which probably will force you into the same or higher tax bracket than you are today. And so if we expect tax rates to go up, could be a reason why to start looking at more strategic Roth conversions now to offset some of the taxes. And, we're typically not fans of converting everything, but small amounts over time can be very valuable. So maybe you look at your situation now, what would be a great window to do right now so that you can have more diversification, right? Not all your eggs in one basket. We don't want everything in tax deferred. We don't want everything in tax free. How do we have a balance so that in the future, when we do turn 73, we're not only forced to take out investments from here, we can choose this too, and we can take it from here, and we can strategically make sure we're not bumping ourselves up taxes or paying more in Medicare premiums or forcing ourselves to overpay in taxes. And the other thing with that Roth conversion, we talked on it earlier, but this is a long-term plan. Now, if you expect your tax rates to be lower in the future than they are today, then you should not do Roth conversions. But in most cases, as I mentioned, most of our clients are going to be in the same or higher tax bracket, which is why it makes sense. But again, that's why the future projected plan makes sense. And that's what we do with our clients. And so maybe they're working right now and making a heck of an income. Next year, they're going to turn 58 and retire. Well, that may be a great window of time between 58 and 62 or 65 or 63. Any of those windows before Social Security starts, before Medicare premium starts. Maybe they can get a delayed pension. And then you can really maximize those times. And so it's all about the timing of it, but also what's going to make sense for your situation. And this can be a very complex calculation. We use a lot of software when making these decisions with clients to make sure we're optimizing that decision and, deciding should we do 50,000 conversion or 100,000 or none. Well, we need to see how's this going to play out over time. So you want to work with a team who's going to run those numbers for you. The second thing that we're seeing to concisely share where CPAs may not be telling you of different opportunities and strategies when it comes to charitable gifting. And this is a big one. So understand next year in 2026, if you haven't heard this yet, you're going to be able to give $2,000 if you're married filing jointly or $1,000 if you're single and be able to write that off on your taxes. So make sure you're saving those receipts to do that efficiently. But if you're giving $5,000 or more, you're likely not right now. Standard deduction is probably all you're taking. 90% of people take that. So you're not itemizing deductions to be able to write off those charitable deductions. So if that's you, I want you to consider some other strategies. One may be a donor advised fund. That's become a really popular strategy right now during these times. Also, if you're 70 and a half or older, I know a lot of people watching this aren't necessarily 70 and a half or older. Most of them are in their 50s and 60s, but that could be something you look forward to at that point where you can give money from your IRA to a charity tax-free. So many times we see that clients give to charities and they're 70 and a half and they're not getting any benefits and their CPA is not bringing that up. So make sure that's something you're looking at. The third point that we see CPAs very rarely bring up is the taxation on Social Security. So if you are 62 or older and you've taken Social Security, this could be, for you. You may not understand that your Social Security does not have to be taxable. It could be tax-free, and about 90% of people right now have Social Security tax-free due to the bonus deduction that just came in with the one big beautiful bill for those who are 65 or older. But for those in this crowd who most of them have their Social Security partially taxable or all taxable, there could be ways to reduce that taxation. And so there's a provisional income calculation that many CPAs do when they file your taxes, but they may not look at strategic ways to reduce that Social Security tax in the future. And so if you look at your tax return, you'll see you received $30,000 of Social Security, and maybe you see that $25,000 was taxable as income. That doesn't have to be anything there. You could have a zero there if your income is low enough and strategically placed in a position to be able to do that. So most CPAs are not going to help you understand how that Social Security taxation works. You do want to look into that because that could be a way to keep more of your Social Security hard-earned dollars that you work so hard to accumulate and keep more of that in your pocket, less to Uncle Sam. The fourth thing we see many CPAs don't bring up is when it comes to Medicare premiums. Now, this is something that's not necessarily going to pop up on your tax return, so they may think it's not their responsibility. Now, with the Medicare premium tiers, that's going to be dependent on your income. So when you look at Part B and Part D Medicare, you're likely going to get on that at 65 if you're retired. And then you're going to look back at your 63 income for Medicare to decide how much do you have to pay. So let's say at age 63, you had zero income at all. You'll pay the base Medicare premium tier and you'll pay a much lower cost for Medicare than what most of your peers will pay. As soon as your income starts to become much larger, which can be the case with our clients with pensions and $1 million plus saved and Social Security, when you add all that together, they're probably going to be in a place where they have to pay more for Medicare throughout their retirement. Now, this is key because it starts getting calculated at 63. So once you're 65, they always look back 2 years, 66, 64. They always look back the 2 years. So this is something that if you don't keep a really close eye on, your CPA may never be able to find this and you could end up paying more for Medicare. And here's the kicker. You may not understand it since it's 2 years delayed. You may get a check and say, oh, wow, I got to pay 2-3 times the amount of Medicare than what I did the year prior. Why is that? Well, because your income 2 years ago was higher than what you expected it to be and it was over those tiers. So something you want to plan ahead for. For a lot of our clients, we look to get ahead of this and start planning before they're 63, or even if they are, maybe we look to blitz the Medicare premiums, maybe with a strategy like a Roth conversion we mentioned, so that we can have lower Medicare premiums for the rest of our life. So this is something, Medicare's in trouble. I don't expect them to make this more generous. I expect them to make it less generous, which means that it could cost more or they could lower the tiers so that more people are subject to paying more for it. And so that's something we want to plan for. The fifth thing that CPAs may not bring up is preparing for those required minimum distributions we talked about earlier. Again, a CPA may not give you planning advice. They may not understand how much you even have in your tax deferred investments, let alone how much your net worth is. And so they may not be necessarily telling you to do things like that strategic Roth conversion or other tax efficient income planning, so that when that time comes at 73 or 75, you may be forced to just overpay in taxes from being required to take that out with no planning. And remember, if you have $1 million right now and you're 60 years old, that $1 million could grow to $2 million by the time you're 73 or 75, just with a simple, 5 to 7% return over time. And if that's the case, your RMD at $2 million, would be about $80,000 you're required to take out from your investments. And you can't barter with the Uncle Sam and say, well, I'll just take out 40, I might worry about that later. You can't do that. You can be strategic and do things like qualified charitable distributions that we mentioned, or you could maybe do some Roth conversions now to lower that amount in the future. But you got to be proactive, because when that time comes, it may be too late. So here's a big one for clients that we see. A lot of our clients, not a lot, but many of them, look to maybe retire in different places than where they're at now. Maybe they want to go to Tennessee where there's no state taxes. Maybe they're in California or in New York and they want to be more tax efficient. Well, CPAs typically are not going to advise that, because they don't know what your goals are. They don't know what your retirement goals are. And so that may be something that's missed. But also where this becomes very advantageous is from a tax planning standpoint. For example, let's say you're in New York, you're paying a hefty amount of taxes there. What if you can start to defer your taxes there, and then the next year you move to Tennessee or Florida, and you can pay $0 in state taxes. So for example, let's say Roth conversion, we've talked about that. You could pay a 5 to 10% state tax there, or you could wait and pay a 0% tax. That's going to help your all-in tax fee go to way down by being strategic about where you're going to live in retirement. Again, CPAs may not have that full level of understanding to help guide you there. The seventh point that we see most CPAs don't help their clients with is when it comes to phantom gains and capital gains. So phantom gains would be something on a mutual fund that maybe you've had for many years in a non-retirement account, that every time they sell off any investments within there, there's capital, there's like dividends and capital gains that are reinvested basically, and you have to pay taxes on that amount. And this can be a big surprise at the end of the year when you file your taxes, when you see, oh, I've got $20,000 of dividends. Well, now that leaves less room to do tax planning. Now you're maybe bumped up in another tax bracket, and it can lead to big concerns throughout a retirement year after year. And so most CPAs are just going to ignore and just say, hey, here's how it is. They're not going to tell you, hey, maybe look to do more tax efficient strategies such as an ETF, or maybe some individual stocks and look at tax loss harvesting. But even further than that, they're not going to help you with those strategies. And so that's why it's important to work with the team that we mentioned earlier, so that everyone can work together. And we've seen value with the CPA and an advisor working together, so they can get a better handle of, hey, here's where the capital gains are going to play out on the tax return. Here's what we need to do throughout the year to make sure we can monitor and manage that. And then the last thing I want to cover on this video that a CPA may not mention to you is the impact of your pension. And all the things that we talked about today. But remember, you're going to be in a higher income situation in retirement. You are going to be very unique. Most people in retirement are just utilizing the standard deduction. Many people in retirement, over 50%, pay no taxes because their income is under the standard deduction, because their Social Security is in that provisional income phase where it's not going to be taxable to them. And so they're going to be in a really good position moving forward. Well, for those that have a high income, high net worth, that 2% club that we talk about, this may not be realistic for you. And so you really need to understand all the details that go apart in planning for taxes with your pension. Pensions, may cause you, if you have a pension $1 million plus, you may have taxes be the biggest expense in your retirement. And it's probably the thing that's least planned for this crowd from what we see. And so that's our goal here, is to bring as much attention to this as possible, to make sure you know what to plan for and you know what to look for. And if you're saying, hey, I'm at the point where I'm done doing this on my own, I want to work with a team, or maybe you have a team who's not coordinate with your CPA, and you feel like maybe things are getting missed, feel free to reach out to us. This is who we serve, the 2% Club, the Midwestern Millionaire. This is what we do. And so I also wrote a book called I Hate Taxes, which talks about this concept in depth. And if you want to request that book, you can go to our website, or if you go to the description below, we'll send that out to you. Or if you want to schedule a time, you'll find that in the description below too. We'd love to connect, see if we can help you. And also, on our website, there's a scheduling page with frequently asked questions. But if you click the link below, it will take you there. So that's all I've got on today's episode of Joe Knows Retirement. We're glad you're tuned in. We're glad you're subscribed to this channel. And we're going to take great content coming your way moving forward.